Good afternoon, everyone. It's lovely to see some familiar names and faces. I can see that you're all joining thick and fast here. We are recording this afternoon's session because there's a couple of people that can't arrive. So we are recording it, but not the Q&A session, just the presentation that I can send out to those clients that have registered, but then have had something come up at the last minute. So I will be switching off recording as soon as we go into the Q&A. But if you don't want your face to appear on the screen, then by all means turn your cameras off. That's absolutely fine. I'm delighted to say that we're joined by the fantastic Cathy Hills again of Pennington Manches. You'll know that she delivered our share options webinar a few weeks ago, and I know so many of you got so much value from that. So that was great to hear. Cathy does have some slides to show you, and we'll kind of power through those, and then we should have time for questions at the end. So feel free to put questions in the chat. We'll just let Cathy do her presentation, because it could be that if you ask a question, she's actually going to answer it later on in the presentation. So I'll keep questions to the end, but by all means put them in the chat and we'll go through those at the end. Or alternatively, raise your hand after the presentation and we can come to you and you can speak to Cathy directly. Okay, so Cathy, I'll keep an eye in the waiting room and I'll just let you do your thing, but thank you enormously again.
Thank you. I will just share my slides, so hopefully everyone can see those. So yeah, I'm going to do a trot through the conditions for S and EIS relief, and then sort of look at the procedure for applying for the relief as well. Just so you know, you probably already know this, EIS and SEIS relief is a bit of a minefield. There's lots of conditions that you have to meet in order to be eligible to issue shares. What I have prepared is something that you can sort of keep hold of for afterwards, which sets out all of the qualifying conditions for EIS relief and what you have to do in order for them to be met. So that is coming your way, because I think some of what I'll go through might feel like I'm trotting through at a bit of a pace. So if I just start, so I suppose the first point is, what are the reliefs? So for SEIS, you get 50% of the amount that you have invested back as income tax relief. And as long as nothing happens that disqualifies you from the relief within the 3-year period after the investment, any gain you make on the sale of those shares will be exempt from capital gains tax. So that's quite good. EIS relief is for slightly less risky companies. So it's older companies than for SEIS, and the limits are bigger. So the relief isn't as generous, but you get 30% income tax relief. You still get the capital gains tax disposal. And then for EIS, you get this other relief, which is called deferral relief. So deferral relief is where you have made a capital gain on something else. So for example, you've sold a second home and you've got a gain for which tax would be due. If you reinvest the gain that you have made into a qualifying EIS investment, then you hold over having to pay the tax on that gain until those shares are sold. So it doesn't completely disappear. It's just held over. Save that, actually, if you hold the shares on the date of your death, the deferred gain never comes back into charge. So you can potentially wipe it completely, and if not, you at least hold over having to pay it until you make some more money on selling your EIS shares. So there are conditions that need to be met in terms of the company, in terms of the investor, and in terms of the actual investment, so how it's structured, what shares you receive, etc. So we'll go through. As I said, I've got a sheet prepared for afterwards, which sets out all of the conditions, but I'm trying to pick out the most important ones in terms of, the ones that people normally don't meet. So qualifying trade, there are a list of trades that don't qualify for EIS relief. Generally speaking, they're the sorts of trades that are asset backed, or they're considered less risky. Ironically, after the last few weeks, banking is considered to be a less risky trade and is not eligible for EIS relief. But things like accountancy, legal, and then, as I said, asset-backed trades. So things like hotels aren't qualifying. Property, if you have a property investment, it might not be qualifying. When you're looking at whether or not your trade qualifies, there is a little bit of a carve out. So as long as what you are doing is substantially a qualifying trade, then you can still qualify, even if you have some of these excluded trading activities within your business. HMRC, when they're looking at whether or not something is substantial, apply, it's a bit rough and ready, but it's a 20% test. So you can have sort of 20% of your trade as non-qualifying, and the company can still qualify. And when you're looking at the 20% test, you're looking at things like turnover, profit, net assets, the amount of time that's spent on that activity. And then the idea is that you sort of step back and as a whole look at whether it looks like it makes up 20% of your trade. So as I said, it's a bit of a rough and ready test. You can ask HMRC whether they consider that test is met or not. Gross assets test. So it's the size of the company that can qualify. Gross assets is top line of balance sheet. So before you take away any of the liabilities. And it depends on whether you're looking at EIS or SEIS. So the EIS figure is, there's a before and after the investment figure. So you have a £15 million before the investment and 16 million immediately after. I should say that what we sometimes find is that the investment is being made up partly of EIS and partly of non-EIS. And in that case, it is possible to split the sort of completing the round. So you complete, the same with SEIS, you complete the amount up to your gross asset limit on one day. And then on the following day, you complete the rest, because as I said, it's an immediately after test. So as long as you meet it on the same day, so immediately after you've issued the shares, you don't have to worry if on the very next day you go over that limit. And then SEIS is about to change. So at the moment you have a limit of 200k, and that is going up from the 6th of April. And it is going up to, I think, 400k from the 6th of April. It's doubling, the limits are doubling. So, and we only actually look at that test before for SEIS, we don't look after. In terms of the independence test, the company needs to not be controlled by another company. You also have to look sometimes at, if you have an investment by a fund, you might need to look at the structure of the fund to work out whether, what controls the fund is a company, because if it is, then although the fund itself might not be a company, you might still need to consider whether or not the company will be independent. The independence test does have to be met throughout the 3-year period from the issue of the shares, and control for these purposes means more than 50.1% of the shareholding. So particularly for sort of your earlier stages, it wouldn't be that uncommon if you found an investor who's putting quite a chunk of money in, that the amount that they receive is more than 50% of the company. When you're looking at these tests, there is sometimes ways around this. So the test is 51.1% of the shares, but based on the nominal value of the shares, so your par value for the shares, not based on how many shares are held. And secondly, it's based on voting entitlement. And when HMRC are looking at voting entitlement and control, they're looking at the positive ability to be able to force the company to do something. So if you were in a situation where potentially you were going over this 50% test, it is possible to create a different class of shares for your investor, which have a much lower nominal value. they would have the same entitlement to assets on a distribution, whatever their percentage holding ends up being. But the idea is you have a low nominal value so that actually their holding, when you're looking at nominal value, is below 50%. And then what you would do is you'd set some terms out in the articles to block their ability to vote, have voting entitlement above, say, 49.9%. And then to compensate for that, you would give the investor some veto rights. So, for example, the investor can veto the appointment of a new director. The investor can veto, entering into a contract above a certain amount of money. And although that gives the investor the ability to stop something from happening, because they can't positively force something through, that's not considered to be control. So that's just something that might crop up. We find that crops up quite a lot, actually. So it's just a way around that. And then in terms of the permitted age, obviously for SEIS, you have to be quite new. So you have this two-year period. And then for an EIS company, it depends on your type of company, and we will come back to this concept. So for most companies, the permitted age is 7 years. So if you are more than 7 years old, and that's from your first commercial sale, not from the date that you incorporated. If it's more than 7 years since your first commercial sale, then potentially you don't qualify for EIS. If you are what's called a knowledge intensive company, those limits go up. So you then have 10 years. And I'm going to come back shortly to explain how you become a knowledge intensive company. That's the sort of basic age requirement. It is possible to get around those rules. So if you have received SEIS or EIS investment during your initial permitted age period, so the 7 or the 10 years, then you, as long as you have told HMRC that you will need more funding at some point in the future, then you can take on further investment after that period has expired. Secondly, if you're over that limit and you haven't taken on any funding, it is possible to still get EIS if you are either entering into a new geographic market or a new product market. So that's not, it's not a new product or a new geography, it's a new geographical market or product market, which effectively the question is, when you're looking at the black book of people that you have to sell to, do you need to find new people to sell to in order to sell that because your current customers don't buy it? HMRC and their guidance, I don't know if this is a helpful example or not. It helps me because it's an example based on shoes. So what they say is, let's say you have someone who owns a shop and they sell sort of mass market shoes. If they change their business to decide to sell bespoke made shoes, then clearly the sort of person who is going to come in and buy mass market produced shoes is unlikely to also be the person who's going to buy a £500 pair of bespoke made shoes. So on that basis, you have to start your black book again, and effectively then the company becomes risky again and deserves to get risk capital funding, is the idea behind it. So that's our permitted age requirement. Just move on to the next slide. So then looking at qualifying investor. Now, if you're the company to a certain extent, this isn't your problem, it's the investor's problem. However, they will make it your problem, so it's worth knowing. So the first one is that they have no connection with the company, and connection can arise in two ways. Either you're connected because you have what's called a material interest in the company. That means an interest in the shareholding of 30% or more. And that would include, it's aggregated with whatever is the existing round. So you would need to make sure if someone had already invested that the investment plus the new investment is below this 30% holding. When you're looking at the material interest, you also need to look at whether anybody's associates have a material interest. So that is business partners, spouses, and then lineal descendants. we can sometimes get around this test if someone's got, you know, a trusted daughter or son-in-law, because obviously they're not lineal, or siblings. I don't know about you, I wouldn't trust my siblings with any investment of mine, but some people might have better siblings than me. And then secondly, you could be connected through employment. So if you're an employee, you're connected with the company and you wouldn't be able to qualify. If you're a director, then the fact that you're employed by the company doesn't count. So you just look at whether you're connected through the directorship. Someone who is an unpaid director, who is not entitled to any pay and doesn't become entitled at any point during the 3-year period from their investment, are effectively completely ignored. So they can make their investment, they can continue making investments for so long as they are an unpaid director. If you are a paid director, then there is still a limited carve out. So HMRC call it an angel investor. So someone has come on board, they've made their investment, and then in order to effectively protect their investment, they become a director so that they can oversee what's going on in the company. And of course, that's not particularly unusual. As long as the shares are issued before the person becomes a director, and as long as the amount of remuneration they receive is reasonable, i.e. it's just a market rate remuneration, then that investment can qualify for relief. And you have a further 3-year period where that person can continue to make investments and can continue to qualify for relief. And then once you get to the 3rd anniversary of the first issue, before you became a director, you can no longer qualify. You'll be considered to be connected with the company. But obviously, if you get all of your investments in within 3 years, then that investor can qualify. And then this not an existing shareholder rule, it's an annoying rule that got put into place because we are part of the EU, and actually now we're no longer part of the EU. It might disappear, I don't know. The idea is that if you have ever been issued with shares in this company and not got relief on those shares, then the idea is that why would you need it on this one? So the company doesn't need to offer you EIS relief or SEIS relief to be able to attract an investment from you. So if someone has invested for EIS or SEIS before, they're not an existing shareholder, they can continue to make their investments. So it's only if they hold non-qualifying shares. The first important point is that subscriber shares are ignored. So if they are a founder, they've taken shares on incorporation of the company, those shares don't count. This is a snapshot test, so you only look at it at the very moment that an investment is made. So if someone has always held non-qualifying shares and then decide they want to make an EIS investment, again, I'm going to go back to this. Do you have someone you can transfer them to so that you no longer hold them, and then you can make your EIS investment? With this test, we don't worry about what an associate holds. So in this case, you could actually transfer to a spouse or civil partner your non-qualifying holding, in order that you as an investor could then make a qualifying holding into the company. And it's kind of a neat way around it, especially if it's a spouse or civil partner, because the transfer itself would be capital gains tax exempt if those shares that you already held stood to gain. And then there's obviously a maximum amount that can be invested. There are company limits and there are individual limits. So for SEIS, the limit is 150k. That also goes up on the 6th of April. It's being doubled. For EIS, we make this distinction again between an ordinary company and a knowledge intensive company. So we have the individual limit is either £1 million per year, or it's £2 million per year. If anything over and above the million is invested into knowledge intensive companies. So actually you could invest your first $1 million in any company, and then anything that exceeds it in a knowledge intensive company. There is a rule for EIS relief where you can treat your investment as having happened in the immediately preceding tax year. So in that sense, if you were investing into a knowledge intensive company, you would actually have up to a 4 million limit in any one year if you hadn't made any investments in the previous year, because you can treat some of the investments as taking place in that previous tax year. From the company's perspective, the company has an annual limit of how much they can raise under any risk capital scheme. So that's EIS, SEIS, VCT. And that's a limit of 5 million, and it applies on a rolling basis. So in any 12 months, has that limit been reached? So it is possible potentially to time an investment so that one falls out of account because it was in the January of the previous year. So if you wait till the February of the next year, that investment has come out of account. If you are a knowledge intensive company, that limit is doubled to 10 million. So you can make 10 million of investments in any year. The overall limits for EIS is 12 million for an ordinary company and 20 million for a knowledge intensive company. So that's the maximum amount that investors can pay and still get the relief. And then turning on to how do you structure the investment so that it qualifies? So your company qualifies, the investor qualifies. How do you make sure that you don't do something that means that the shareholding doesn't qualify? As I said, there are more tests than this, so I'm just picking out the key ones. So the purpose of the issue test is that the reason for the shares being issued has to be to raise money for the company. It can't be part of any sort of tax avoidance scheme that you're entering into on behalf of the investor. And then the next one is related. So the risk to capital, you have to be able to demonstrate that the investor's taking a risk, that they might lose all of their money. And you have to also be able to show as part of that the intention of the company is to use the money to grow and develop. So in raising investment to maintain status quo is not qualifying. You have to use it in some way to grow. And the sorts of things that HMRC are looking at are you're growing your head count, you are growing your office space, or you're taking out new office space. You are in some way developing your product. So you're entering into pilot studies, or you're going to do some test sales, or if you're looking at sort of a medical company, you're getting to some sort of clinical trial. And in the application that goes to HMRC, they are very fussy about you being able to demonstrate how you're spending the money. So they will require a cash flow forecast, which shows how the EIS money will be spent. And they will also require detail on how that grows and develops the company. So just paying for existing staff salaries is not EIS qualifying. Bringing in new staff and using the money to pay for new staff salaries is qualifying. And then just to sort of further demonstrate the risk to capital requirement, as I said, the reason for these reliefs is that it's a way of encouraging investment into companies that are early stage and potentially risky investments. And so what you're trying to demonstrate is that the investor doesn't have a guaranteed return. The company doesn't have some sort of asset that it could sell to deliver the investor their money back if everything went wrong. The investment money is being spent, and at the end of the investment, yes, clearly the hope is that the company is more valuable, but there is a risk that the investor might lose all their money. Certainly in the companies I deal with, that tends to be quite easy to demonstrate. We tend to have a cash flow forecast that shows a cash out within a few years of the investment. In terms of the type of shares that can be issued, they need to be shares that are ordinary shares in the company, by whatever name called. They need to be full risk shares, so you can't do anything that protects the investor from the risk of their investment by the class of share. And they also need to not have a preferential right to assets on a winding up. As is often the case with EIS and SEIS, there is a rule and there is sometimes a workaround a rule. So in terms of the risk to the investor, there's not a lot you can do, but there's the sorts of things that would cause the investment not to qualify is, for example, if you had some sort of anti-dilution protection in the articles, and classically how that would be structured is if the investor makes an investment and later on there's another investment round at a lower price, then the investor gets issued with more shares to effectively bring their price per share down to the same as what the new down round price per share is going to be. That's not acceptable under EIS. You can't offer any protection whatsoever. But in terms of they can't have a preference, you may find that most investors want some sort of preferential return on their investment. And it's quite common to see them ask for a 1x return. So they get their investment money back before anybody else gets anything out of the company. On the face of it, that's a preference. HMRC have a slightly weird practice when it comes to this preference test. And what they're looking at is the timing of receipt rather than the amount of the receipt. So it is possible for the investors to get, say, 99% of their investment money back at the same time that the other shareholders get the 0.1% or 1% of the investment, and then for them to participate in the remaining distribution. So although clearly they have received a lot more back of the investment before there's just a pro rata distribution, HMRC say that's not a preference because everybody receives something at the same time. I think when it comes to that sort of structuring, it is quite common. We see that quite often in documents. I'm going to come on to the advance assurance process. My personal recommendation is if you are using that sort of structuring, you really should get an advance assurance, because HMRC can sometimes change their mind on their practices and procedures. And to my mind, their interpretation of the legislation is way more generous than it should be here. And if they later decided to change their procedures and practices, you'd want to make sure that what they had said to you, they couldn't change their mind on. And the easiest way to do that is an advance assurance, and I'll pick up on that shortly. But that is potentially possible. Maximum amount. I'm sorry, I covered it in the previous slide. This is the maximum amount that the company can raise. So then I keep mentioning this knowledge intensive company. They have higher limits in terms of what they can get in terms of what the investor can put in. There are 3 conditions. You have to meet the first one, and then you have to meet either or of the second 2. So the operating costs condition is looking at your R&D expenditure as a percentage of your total operating costs. And there are 2 tests within this, and you can meet either one of them. So either in all 3 of the immediately preceding tax years before the investment, at least 10% of your expenditure needs to be made up of research and development expenditure. Or alternatively, in any one of the 3 preceding years, at least 15% of your expenditure needs to have been in R&D. If you are a company that is less than 3 years old, then what you'll need to be able to demonstrate is that your projected expenditure on R&D is going to exceed those limits. So it doesn't mean you can't become knowledge intensive. The second test, which is the innovation condition, it's a test that says that whatever you're doing with your R&D, so the IP that you're creating from it, your expectation is that within the next 10 years, exploiting that IP will become the main part of your business. And exploiting the IP could mean that, you know, it's part of a product that you sell, or it could mean that you're licensing, you know, the intellectual property, so you've got a license. It doesn't matter which one. And then, as I said, it's either the innovation condition or the skilled employee condition that you have to meet. Less companies meet the skilled employee condition. So in order to meet that test, at least 20% of your employees need to be qualified to a master's level or above, and working in a role that requires that level of qualification. So basically you have a bunch of really clever employees working on your research and development. Again, that test either needs to be met at the time that you make the application, or if you are less than 3 years old, you have to be able to demonstrate that it will be met for the next 3 years. So then just looking at the process, you know, how do you become SEIS, EIS qualifying? The first point to note is what I hear a lot of investors say is, you know, do you have EIS or SEIS approval? You used to be able to apply for advanced assurances just on a speculative basis. So you used to effectively be able to get pre-approval from HMRC that when the time came and the investment was made, they would issue all of the certificates they needed to issue for your investors to be able to claim EIS relief. I think that HMRC's department got way too busy. It was taking sometimes 4+ months to get a response on anything from them. So to address that, what they said is you can no longer make a speculative application. So in order to ask us if we would potentially allow this investment to qualify, you have to be able to name an investor. And that is an investor name, address, and the amount that they're proposing to invest. In one sense, it is still possible to apply on a slightly speculative basis, as long as you have a friendly investor who's prepared to put their name and address on the form and, you know, potentially put in some money up front. So the advanced assurance process is effectively an application which runs through all of the qualifying conditions, explains how those tests met with supporting documentation, and then asks HMRC, when this investment is made, will you give us the permission to issue the EIS certificates for our investors? Over time, HMRC get excited about one test or another, so it changes. At the moment, I've already mentioned, the thing that they're really interested in is what you're using the money for and making sure that that is growing and developing the company. So in terms of the level of evidence that they want from that, it is certainly much more than I've seen in past years. As I said, they will expect to see a cash flow forecast setting out the projected expenditure of the EIS money. And they will expect a full description of how the EIS money is being spent, including how that grows and develops the company. If you don't send that information, HMRC will just come back and ask a heap of questions, and the whole process will take much longer. So you will need those documents. You'll need management accounts, projections, cash flow forecasts in a final form to send to HMRC. Hopefully you have prepared some sort of business plan for the investor which sets out, you know, your plans to grow and develop the company, and that can be included. The other thing I find is that if you just send them the information in documentation and don't actually tell them about it, they will also reject the information. They can't be bothered to sift through loads and loads of documents. So in your covering letter or application, you will need to set out exactly where you've demonstrated this, and point out how you've met the conditions. The advanced assurance process is much quicker than it used to be. This is, I think, the sole department of HMRC that got quicker when COVID started. So pre-COVID, I may have got responses within 5 to 8 weeks. during COVID and still now, the quickest response I've had is a day, which is great. And the slowest response is probably 3-4 weeks. So they are a lot quicker than they used to be. In terms of timing of your investments, HMRC fall apart at 2 points in the year: summer, Christmas. If you want to apply for advance assurance during those times, then you need to build in additional time frame. The advance assurance isn't a requirement of any investment. So you don't have to have asked in advance in order for the relief to be available. What you might find is that your investor wants to know in advance if the relief is available. If you think back to the first slide where I set out what the reliefs are, then if you are, if there is a gap between what an investor is prepared to pay for the shares and what you think the shares are worth, then the ability to be able to demonstrate that this relief will be available is a great gap between the two, because you're saying, well, if you're investing under SEIS, the cost to you is only actually half of this headline figure, because you're going to get the rest back in tax relief. So we're not that far apart on valuation. So the ability to have the advance assurance might just help those conversations. And then there are some funds who are set up as EIS funds. And so part of their approval process is that they will only make EIS investments. And those sorts of funds are going to want some sort of comfort that the relief is available. Because HMRC like to see all of the documents in final form, that can delay when you can complete your investment. So you just need to be mindful of sort of timing on that. My next point is comfort letter. So effectively, what a comfort letter is someone who knows about EIS relief, SEIS relief, sending a letter to the company, setting out how all of the conditions are met, and explaining that their expectation is that the relief will be available. So we do have investors who, because of the timing of an advance assurance, are prepared to accept a letter to say, look, this relief is going to be available. There's no issues. I've looked through all of your documents. There's no issues with the structure of the investment, and the company itself qualifies. So that's an alternative way of sort of dealing with getting an investor over the line who wants some comfort that the reliefs are going to be available. ASAs, that's shorthand for advanced subscription agreements. So this is where it's often the case that these are entered into where you've got someone who's prepared to stump up some cash early, but the price for the round hasn't been set yet, and you'll need, other investors to come in before you have fully agreed on what the price for the round is. So what an advanced subscription agreement does is it binds the investor to subscribe for shares, but it also gives you the cash on day one. So you get your cash, but no shares are issued. For EIS purposes, it's the date that the shares are issued when we have to ensure that all of these tests have been met. So effectively, we ignore the fact that there's this subscription money in the company until the issue date for the shares. It's quite typical under an ASA for the price that investor pays to be discounted in some way. So they might pay 20% of what is the final round price for their shares on the basis that they've committed their money early. They've taken the biggest risk in a way. It is important that these are drafted properly. If you convert a loan into shares, that is not EIS qualifying. EIS shares have to be issued for new money. The advanced subscription agreement is making it clear that the money is going in not as a loan, but as an advance for shares that will be issued when the price for the round has been set. HMRC say in their guidance that you need to have issued the shares within 6 months of the date of an ASA. it's not quite what they say. So a lot of people take it that the ASA has to have a long stop date of 6 months. But actually what HMRC say is they won't give advance assurance if the long stop date on an ASA is more than 6 months. They also won't give an assurance if you wait until the ASA only has 6 months to run and then ask for assurance. But they don't say that that subscription won't qualify for relief. They just say they won't tell you in advance if it does. So you'd need someone else to go through those tests and make sure they're comfortable the relief is available. The other thing ASAs can be used for is where a company needs some sort of bridge funding, and either it or the investor have gone over their annual limits. So because all of the tests for EIS aren't tested until the shares are actually issued, let's say you have received 2 million of funding from somebody, they don't have any relief that they can carry forward from a previous year. So they've hit their maximum amount that they can fund, but then the company's running out of money and it needs money before we get to our next 12-month period. It's possible then that you could invest via an ASA, so they could give you another 2 million at that point, and you just make sure that the shares were issued once they were past their anniversary of the previous issue, and in that way they can continue to qualify. And then once you have issued shares, whether or not you've applied for an advance assurance, you need to actually apply for the relief. That's something that the company does. You have quite a long time to do it. You have 2 years from the end of the tax year in which the investment is made. Hopefully you do it straight away so you don't forget. But sometimes that can help, especially I've actually just had someone who wasn't advised at all when they made their investment. They made their investment in September 2020, which means the end of their tax year that they made the investment was April 21. And we have exactly 3 weeks left in which they can claim their investment. And we just received it this morning. So we have just hit their 2 year after the tax year timeframe. If you have applied for advance assurance, then the application for EIS is much easier because lots of the questions automatically get swiped away. And if you haven't, then effectively you have to go through the advance assurance process in terms of the documentation when you apply for EIS. The form is called an EIS1 form. And what you get back is an email from HMRC, which is known as an EIS2, which is just HMRC saying, yeah, this investment qualifies. And then they will send with their email a form EIS3. And the EIS3 form, there's a front page that's completed by the company, and then the company sends that off to the investor, and that's the form the investor needs to be able to claim the relief on their tax return. And that's end of the process, apart from obviously the fact that a lot of those qualifying conditions have to be met throughout that 3-year period. So it's checking that if you're making changes to the articles or you're creating a different class of shares, that you're not doing something that inadvertently means that the existing investment fails. The whole process for EIS and SEIS has recently gone online. So previously, you would email a copy of the form to HMRC, and then they would reply by email. They still reply by email, and if they have any follow-up questions, they ask them by email and you can respond by email. But all of this has gone onto the government gateway account. So if you were applying for either advance assurance or the relief, you would need to make sure you'd set up a government gateway account to allow you to do that. They actually ask different questions than they did in their previous forms, but the benefit is that actually you don't have to do it all in one go. You can come back and you can answer questions bit by bit, whereas the previous form was an online form that wasn't, you could save it once, but you could then, you could never make any changes to it after that. So it was a slightly irritating process. It's now online. It means you can go back to it any time, but there are slightly more questions than there used to be on the form. Okay, so I have rattled through the reliefs. It is a bit of a minefield. There's lots to talk about. So I think we probably do have some time for questions.
We do indeed. Thanks so much, Kathy. And as Kathy said, we've got a handout to give after this session as well. So let's go through the questions in the chat, Kathy, if that's okay initially, and then if we've got time, anybody else got anything else, they can put their hand up. So Kate's asking, so to get an SEIS qualification you need an investor, but to get an investor you need to show SEIS qualification. It's a bit of chicken egg, isn't it, really?
Yeah, I suppose, I mean, an investor won't make the investment until if they are interested in the relief, they won't make the investment until they know it's available. So effectively what it does is it pushes everything backwards because you've got that delay. And I suppose, you know, there are advisors who understand this relief, so without getting